Let's go on to another standard, which is Ind AS 102, share-based payments. Now, you would have also understood what is share-based. Under your Indian GAAP, you had a guidance note for the purpose of employee share-based payments. Okay, so if you issue certain ESOPs, that is, if you issue ESOPs to your employees, what to do, how to account for it, how to value those ESOPs, how to give the impact in P&L, was given in accordance with a guidance note in your Indian GAAP. There was no particular standard over it. Whereas under Ind AS, you have a standard on share-based payments. This does not only cover employee share-based payments, but this also covers all types of share-based payments. So what comes additionally in it? If there is a vendor, he has supplied me goods. In exchange of payment for the goods, instead what do I do is, I tell him I will give you an option, or I will give you an option of my company. I will give you a payment in the form of shares. So that is a share-based payment. So it is not only specific to employee, but it is specific to any particular organization or any particular vendor or any one of the company to whom the payment is given in the form of shares of the company. Okay. So moving ahead to what is the guidance given under this standard. So there are certain definitions given. Now, a share-based payment arrangement, in such share-based payment arrangement, you can issue your own shares for the purpose of this payment, or you can give a cash or any other asset, and the value of such cash or asset is dependent upon these equity instruments. So for example, today I say to my employee, if you stay 3 years in my organization, I will issue my own shares. I will give you my own shares. This will be option available to you. And if my normal fair value of my shares is say rupees 100, instead I will issue those shares to you at rupees say 70. Now what is the motivation to the employee? If he stays for a period of 3 years in the organization, then he will get a share of the company at rupees 70 at a discounted value. So in those cases, what do I do is, the employee is motivated and I'm giving him a consideration which are by way of issuing my own shares. Second way can be, instead of giving my own shares, I will give you a cash differential. So if my normal share price is say rupees 100, at that point of time, whatever would be my market price, I will give you difference in accordance with 70. So if my market price is 100 at that point in time, I will give you difference of rupees 30 into the number of shares. Or if the market price is 120, then I'll give you 50, difference of 50 into the number of shares. So what is the mode of payment is? The mode of payment is by way of cash or by way of any other asset which is dependent upon the equity value of that company. So very much important is, it should be dependent upon the value of equity instrument of that particular entity or any other entity within that group. What does it mean? If I am a subsidiary company, my subsidiary company is not listed. Now, since my subsidiary company is not listed, employees will never be motivated to have my own shares. But my holding company is Tata Motors, which is a listed company. Now, when I give that shares of Tata Motors as an option to my employees, the employees will be more motivated because they know the value of Tata Motors on day-to-day basis. It is a listed company. So even if I am issuing the shares or I am issuing the option to subscribe to my shares, even of my any other entity from the group, it is also a share-based payment, and even the accounting for such share-based payment will fall under this standard. Okay. Now moving to the types of share-based payment. As I discussed, it can be equity settled, it can be cash settled, or it can be both. You have an alternative. If you want equity shares, I would give you equity shares. If you don't want equity shares, you want cash, then I will give you cash in such cases. So these are the three options given by the standard. Then here in the third case, the cash alternative can be with the buyer, that is a subscriber to the shares, or it can be with the entity also. So if I have the option, in that case is how to account for it. If the employee has that option, in that case is how to account for it. Now in this, whenever I'm covering the standard, please note every time I'm using the word employee itself because it is more common in nature. You would find various companies who has this ESOPs. If it is a listed company, then ESOP would be the most common feature. If it is a company who is going into IPO, who is filing its DRHP, it is again a most common feature to issue the options or to issue the share options to its employees. Okay, so moving ahead to the another part. Then your accounting significantly depends upon whether it is a equity settled share based payment or it is a cash settled share based payment. Because in option 1 you're going to issue your own equity shares. In option 2 you have to give the cash. You have to give the cash to the counterparty, to your employees, for example. Then accounting for each of this part is separate. Now, which is a third case where you have a cash alternative. If this alternative is with the counterparty, that means, for example, if employee has an option that he can either settle it in equity shares, he can either ask the company to issue the equity shares, or the second option is he can ask the company to settle it in cash. If that option is with the counterparty, then it is a compound financial instrument. We have discussed this word of compound financial statements previous day when we were discussing the financial instrument standard. So this is a compound financial instrument. And if that choice is available with the entity, if the issuer is having that choice, then in such cases, you will decide what is the company's intention. Is the company intending to give it in cash? If the company says yes, you will not just rely on to what the company is saying. You will also see whether the company is having the financial ability to settle it in cash. Or what is gonna company do? Is the company gonna settle it in equity shares? So we will decide what are these two cases, and accordingly the accounting will depend upon each of these options. The accounting will change for each and every part. Please remember. Okay. So moving ahead to the next part. You might be remembering, whoever are there or whoever have studied the Indian GAAP, they would be knowing what is vesting condition and which is a non-vesting condition. Okay, so it depends. You have to take into cognizance what are the vesting conditions, and these vesting conditions, whether these conditions are achieved or they are not achieved, plays an important role in your valuation and plays an important role when you're debiting the expenditure in your statement of profit and loss. So vesting condition, for example, can be the employee is having, or if the employee will stay into the organization for a period of 3 years, only then this option will be available to the employee. Only then the employee will be having an option to subscribe to the shares of the company. So this is a vesting condition. It is as good as a conditional in nature. If you leave the organization before 3 years, the share-based payment or the employee stock option will not be available to that particular employee. So this is the case. Then what is a non-vesting condition? We'll discuss in the next slide. So non-vesting condition would depend upon various market parameters. So this is not dependent. So whether the shares are issued to you or not issued to you will not be dependent upon these conditions. This is called as a non-vesting condition. So we just discuss it ahead in nature. Now, in some cases, it might be the vesting conditions would be performance oriented. It might be, for example, if you're issuing the shares or if you're issuing the share-based payment arrangement to your top management, you just can't say that if you stay in the organization for a period of 3 years, then I'll give you this share-based payment. You might have to factor in various other factors. So for example, you give a target. If the EPS is above this level, then these options will vest to you. If the EPS is not getting achieved above this level, then the options will not be available to you. So this might be one of the condition. Or the another condition might be there should be 10% growth in revenue every year. This might be another condition. This is a performance oriented conditions. And it is just not about how many years the employee is staying into the organization. So this might be one of the performance condition. Another performance condition can be What will be the share price of the company? What will be the return given to the shareholder? These are various types of the conditions. They have classified the performance conditions into two parts. One is market performance condition and another is non-market performance conditions. So this market conditions is not only in the hands of the counterparty. Now market share price can change by any other parameters also. It is not purely in the hands of the employee to what extent the market price should vary. Okay, and the second might be the non-market condition. So what does it mean? The examples that I gave, the earning per share, how much is the turnover of the company on account of completion of any kind of project. So these are the non-market conditions. Okay, now why are these conditions relevant? Why are we discussing these conditions? So we'll understand in detail. Firstly, let's take an example. On 1st January, XYZ grants an option to an employee. Now, what has been said that the employee must remain into the organization for a period of 3 years before they can exercise this option. Now, whether it is a service condition or it is a performance condition, as I discussed earlier, this is a service condition. If it was said in this case that the employee has to achieve a earnings per share of minimum 10 in each year, only then the option will vest to that employee. In such cases, it is a performance condition. Now, it is upon the performance of the employee how the share-based payment is reaching to or how the option is getting vested to that particular employee. So, you have to divide whether it is a service condition or it is a performance condition. Moving ahead to the next part. That is, what are the non-vesting conditions? Now, non-vesting conditions are such kind of conditions which are neither in the hands of the counterparty nor in the hands of the company. So neither I can control it or nor the employee can control it. And these are the non-vesting conditions. If I mention that inflation rate should be above 5%, now in that case it is in none of the hands of the neither the counterparty nor the entity. These are the examples of the non-vesting conditions. Then again, one more example for this can be holding shares over a certain holding period, payment of monthly contributions. So these are again the conditions that counterparty can choose to meet. If it is neither in the hand of entity or nor the counterparty, or else it is only in the hands of the counterparty, then these conditions are said to be the non-vesting conditions. Because you cannot assess a particular employee or the option available to a particular employee cannot be dependent upon something which is not in the hands of that employee. If today I say that I will evaluate a performance based on what is the inflation rate, how is my concern or how is my performance dependent upon what will be the inflation rate? And why should my remuneration be dependent upon this thing? Now, one more thing, just as a background, why is this share-based payment so much popular in case of employees specifically? Because this is a mode of remunerating that employee. The more the value of my share-based payment, the more I'm remunerated. That is why should my remuneration be dependent upon a thing which is not in my hands? And that is why these are non-vesting conditions. Okay. So moving ahead to the next part. Impact of these conditions. What will be the impact? Now, please understand the background before understanding what is the impact of these conditions. To understand the background, any kind of options, whenever you have the share-based payment in accordance with Ind AS, you have to value that option. Now, this is an employee stock option plan. Okay, just to give it in a different language, the employee has an option to subscribe to the shares of the company. Okay. Now, suppose if today I issue this option to the employees that after 3 years you can subscribe to the shares of my company at ₹100, whatever might be the share price. In spite of that, you can subscribe to the shares of my company at ₹70, at ₹100. Sorry, I discussed it earlier. Now, if the share price is 200 at that point in time, I have a right to subscribe to the shares of the company by paying only ₹100. Now, if the share price of that company at that point in time is rupees 80, still I have a right to subscribe to the shares at rupees 100. Will I exercise that right or not is a different question. But still I have a right to subscribe to that shares. Okay, this is the case. Now, tell me, in such cases, what do you do for the purpose of accounting is you fair value this option. You fair value the option. Please note the difference. Fair valuation of shares and fair valuation of options is different. In accordance with the standard, in accordance with Ind AS 102, they have said that only the Black and Scholes model or any such popular model will be used for the purpose of the fair valuation. Okay, and whenever any particular standard gives a specific method of valuation, then Ind AS 113 is not applicable. Then you have to use that specific method given in accordance with that standard. Okay, now please understand, you have to value that fair valuation, you have to value that option. Practically, even I have valued various options, and there is a huge difference between the valuation of the shares and valuation of these options. How will you value it? In a very simple terms, please understand. This valuation of these options depends upon how much is the share price of the company. How much is the volatility in that share price? Why do you have to see how much is the volatility in the share price? Because you have to assign a value to an option which is exercisable after a period of 3 years. If a share price is exercisable after 3 years, if a share is exercisable after 3 years, I have to estimate how much might the share price go after 3 years. Okay. Then I have to estimate how much dividend the company gives. Okay. Why is this important? Because as soon as you give the dividend, it has an impact on the share price of the company. So these are the factors that you use for the purpose of the valuation of the shares, valuation of the options. And then the second part is, how do you estimate the number of options? So I'll just note down in my Excel sheet so it is more clearer to you. So the first thing is, I hope you can see my Excel sheet. So please see the highlighted portion and whatever I'm writing the highlighted portion. First thing is valuation of options. Okay. And the second is how much are the number of options which should be used for the purpose of calculation. Now, why do you see how much are the number of options? For example, today I issue 10,000 shares. Today I issue 10,000 options, I would say. These options are issued to 4 employees. Okay, these are issue employee options to 4 employees. Each employee has 2,500 options. Okay, so what does this mean? What does this mean? That I have a right to subscribe to 2,500 shares of the company after a period of say 3 years. Okay, at rupees 100. This is the arrangement. Now what do I estimate is how many employees out of these 4 employees will really stay in the organization for a period of 3 years. Because this is a vesting condition. Now I'll see how many will stay, the condition is will stay for 3 years. Now I will estimate how many employees will stay in the organization for a period of 3 years. If I know out of these 4 employees, but there is one employee who might not stay for 4 years, who might not stay for 3 years, in that cases, I will never consider his option whenever I will decide or whenever I will compute how many options should be debited to the statement of profit and loss, or how much cost should be debited to the statement of profit and loss. Please understand, you will get confused. To decide how much options should be debited to my profit and loss, I will not consider if I estimate that one employee will leave the organization. Why did I do so? Now understand this slide, it will be easier. If there is a service oriented condition or if there is a non-market performance conditions, you have to factor these conditions in the number of options that will be vested to the employee. What does it mean? Let's go back to the slides where this was given. What are the service condition is? Service condition means what? How many years the employee will stay in the organization. If your arrangement, if your employee stock option plan contains a condition which is a service condition, where you will have to factor in this condition, in determining the number of options. Then moving ahead, if there is a condition which is a non-market performance condition, means what? How much will the EPS go? How much will the revenue go? If you have such conditions, then also you have to factor in while determining the number of options that will be vested. Okay. So this I took it as an example. I'll take one more example. This is the second example. For example, I have given an option to employee A that if the EPS is above rupees 10, above INR 10, then I will give you 1000 options. If the EPS is above 15, I will give you 1500 options. And if the EPS is above 20, in such cases, I will give you 3000 options directly. Okay, so better the performance of the company, the higher the number of shares you have. Now, I as a company will estimate how much can EPS really go, or what is the expectation, how much the employee can really achieve. If today I estimate that only based on past trend, he will achieve only 15 as an EPS, then I will give that impact. I will only use 1500 options for the period of my amortization or for deciding how much expenditure should be debited to the statement of profit and loss. Clear? I hope it is clear. Or I'll give you another example. For example, like says that average EPS for a period of 3 years should be INR 10. So this is the average EPS. So whatever I've mentioned it over here, this is the average EPS for a period of say 3 years. Now if first year is already over, in the first year itself, I understand that the average EPS or the first year the EPS is 10 only. It is not 15, it is not 20. So in short, I will give only 1000 options for the purpose of debiting into my statement of profit and loss. I hope it is clear to you all. Only these non-market performance conditions and the vesting conditions should be taken into cognizance while deciding the number of options that is to be vested. Now second, let's go back to our original slide. Any other parameters, that is the non-vesting conditions, for example, was the inflation rate, gold rate, and the market conditions, what will be the share price of the company. These all you should decide at the time of determining what is the fair value of that option. Okay. So this is to be considered at the time of deciding the fair value. And please note, you do not have to make the fair valuation as an auditor. There will be a valuer who will give the fair value, will give the valuation either under Black and Scholes model or there is a binary model for the purpose of valuation of the shares. And these models are very interesting and very good to do. We have ourselves valued various shares for the listed and unlisted companies. This valuation technique is a total different technique than what is given under Ind AS 113. So I hope it is clear to you all. And let's move on to the another part. How do you account for this share-based payments? Whenever you have an equity settled share-based payments, at that point of time, you will amortize the expenditure from the grant date to the vesting date. So over this period, you will amortize the expenditure. But how will you amortize the expenditure? You have to fair value the option as on the grant date. Whatever is the fair value decided at the grant date, you have to use the same value for the entire number of years. You will not keep on changing the fair value. In such cases, fair value is decided only once, that is as on the grant date. Once you decide the fair value, number of options can keep on changing at each year. So what does it mean? You have to do the cumulative adjustment to the number of options. What does this mean? If in year one, I expect that all the 4 employees will stay in my organization. Okay. That is why while deciding the expenditure to be debited to my profit and loss, I take the number of options vested for all the 3 employees. But in year 2, I realize that one employee has already left the organization and the second employee is thinking to leave the organization. In that cases, what will I do? I will do a cumulative catch-up. What does it mean? If only expenditure of 2 employees was debited from year 1 itself, how much would have been the total expenditure? That I will decide, and accordingly I'll debit the balance expenditure to year 2. To take an example, I hope you understand it. For example, in year 1, I decide these are 4 employees. Okay, these are 4 employees. Each employee has 1,000 options. Okay, and all these 1,000 options, the fair value of this option is rupees 10. And estimate that all 4 employees will stay for a period of 3 years and nobody will leave the organization. So here I will debit 40,000 is the total cost for the entire 3 years, and in year 1 I will debit only 13,300. But in year 2 what happens is one employee is thinking to leave the organization. Then how many are the options left? So your options left are 3 options into 1,000 into rupees 10. Okay. So your expenditure should have been 30,000. Means what? Up to year 2. Up to year 2, how much should have been the expenditure debited to profit and loss? That should have been 20,000. Already I have debited 13,333, and that is why expenditure to be debited to statement of profit and loss in year 2 will only be 6,666. This is called as cumulative arrangement, which you will do in equity settled share based payments. I hope it is clear. And please understand, even if there is an exercise date is after 1 year, after 2 years, the period up to the exercise date is not to be taken into cognizance, and only up to the vesting date has to be taken into cognizance for the purpose of deciding how much expenditure has to be debited to the statement of profit and loss. I hope it is clear, and I'm taking this quickly because this is same what was there under the Indian GAAP. Next is measurement principles that you have discussed. So equity settled share-based payment, how do you decide the fair value? And in this cases, how do you decide the fair value? The second thing what we need to discuss is, in case of cash settled share-based payment, it is a financial liability, and you have to fair value this financial liability at each reporting date, and the difference is transferred to the statement of profit and loss. What is the financial liability? We discussed day before yesterday while discussing the financial instrument. So in case of equity settled share-based payment, you decide fair value only once, that is on the grant date, whereas in case of a cash settled share-based payment, you decide the fair value at each reporting date. Okay, debit and credit we have discussed in while deciding now the accounting entry. Debit has to be given to employee benefit expenditure, which is you will debit the account called as share-based payment account, and the credit will be given to a reserve called as employee share-based payment reserve if it is a equity settled share-based payment. And if it is a if it is a financial liability, then in this case the credit will go to the financial liability, in which will be classified in the liabilities portion and which will not go in the equity portion. Calculating expected charge, this is how we discussed in this Excel example. You will decide the number of options. You will take the grant date fair value and you will decide how many number of shares are expected to be vested. And accordingly, you will decide the total value. Okay, you have to spread it over the vesting period and incrementally you will change the number of options. Okay, so this is what I discussed in this Excel example, and this is same as it was there under the Indian GAAP. This truing up also we discussed. This truing up is nothing but whatever is the change in the number of shares. In year 2, you decide as good as what would have been the expenditure for the period of 2 years. If only 30,000 options were vested, what would be the number? What would be the expenditure after a period of 2 years? And accordingly, only difference is charged to the statement of profit and loss, and balance in case balance is amortized for the next year. So in the third year, what would be the charge? In the third year, the charge would be 30,000. The charge would be 10,000. So how is your charge in this cases? In year 1, it is 13,300. Reporting date, and the difference is transferred to the statement of profit and loss. Moving ahead to the next part. Just a moment. Moving ahead to the next part is this also we have discussed. This is a very interesting concept. Please understand it in detail. Group and recharge arrangements. Previously, what we discussed is there might be a case where I'm a subsidiary of Tata Motors, and in my case, I am giving an option to my employees that these shares of Tata Motors will be given to you. You have an option to subscribe to the shares of the Tata Motors. In that cases, what will be the accounting treatment? In such cases, in the books of the subsidiary company, what will be the accounting? Previously, if the shares were of the same company, what was the accounting? You debit the employee share payment account, which is the expenditure account, and you credit your equity or liability as the case may be. Whereas here, if these are shares of Tata Motors, and whether you're going to pay to the Tata Motors, if you're going to pay that proportion to your holding company, it is called as recharge arrangement. What does it mean? You're going to pay that proportion to the Tata Motors. If the value of the shares is say rupees 1 crore, a subsidiary company is going to pay that proportion to the Tata Motors equivalent to what was the value of shares issued by the Tata Motors. This is called a recharge arrangement. Recharge means the holding company is going to recover that cost from the subsidiary company. But what if there is no recharge arrangement? In that case, is what to do? Let's understand both the parts step by step. If there is a recharge arrangement in such cases, your accounting entry will be employee share based payment account debit, which is expenditure account, to payable to Tata Motors. Okay. And Tata Motors will record the accounting entry as recoverable from my subsidiary company, recoverable from subsidiary XYZ, and credit to its equity. Equity will be employee share based payment reserve. So this will be the accounting entry. And if there is a no recharge arrangement, in that case, is what to do? If there is a no recharge arrangement, in such cases, the accounting entry will be expenditure account debit to expenditure account debit to additional investment by the subsidiary, additional investment by the holding company. I'll note it down over here. If there is no recharge arrangement, in such cases, the accounting entry will be employee share based payment expenditure account to additional contribution from the holding company, or also called as securities premium. Why did we debit it? Because the subsidiary is issuing shares to the employees of the, or the holding company is issuing the shares for the employees of the subsidiary company. So in this case, the service is received by the subsidiary company, but the shares are given by the holding company. Why is the holding company issuing shares? It is as good as the holding company is making an additional contribution to the subsidiary company. So this is about what will be the case if there is a no recharge arrangement. And in the books of the holding company, what will be the accounting entry? Investment in subsidiary company account debit. Investment in subsidiary account debit to employee share based payment reserve. So employee share based payment reserve. Okay, the logic is same. Since you're not recovering anything from the subsidiary company, that is why we have debited this investment account. So I hope these things are clear to you. And this is how the group arrangements are recognized for. What are the disclosures under the standard? You have to disclose what is the expenditure debited, how much are the number of options outstanding, how much are the number of options granted, options forfeited, how much are the options exercisable at the end of the period. So these all disclosures you have to give. And please note that these are not generally made by the company who is auditing it. The person who is giving you the fair value of that option, that professional itself gives you this disclosure in this format, whatever is required in accordance with the accounting standard. This is given by that person. How you obtain an actual valuation report? In similar manner, you obtain this disclosure report from that valuer along with the valuation report. I hope this disclosure is also clear. I mean, you don't have to make each and every disclosure, but to give a brief about it, you have to give a reconciliation between what were the opening number of options outstanding, how many options are granted additionally during the year, how many options are forfeited during the year, how many are exercised during that period, whatever is expired. Expired means what? These options are expired and these are no longer outstanding at the end of the reporting period. Out of this, you have to show that how many are exercisable. So for example, the vesting conditions have already been carried, and these options are exercisable at the end of reporting period because the employee has already met the vesting conditions. Okay, then you have to say that what is the average life of the option that you have to disclose, what are the range of exercise prices that also you have to disclose, what is the remaining contractual life that also you have to disclose in your financial statements. So these are all the disclosures that you have to disclose in your financial statements. This is all about the share-based payment reserve. So I hope it is clear to you all and it is understood by you all. Further, to understand this concept, to understand the differences between the standard, if you have to understand the disclosures, what are the detailed disclosures in accordance with standard, you can also refer any particular annual report of a company and decide how are the disclosures given. It will be more clearer to you. Any disclosure just by reading what is given under the standard is not very much clear. So this was all about the employee share-based payment, that is Ind AS 102. And then we'll also discuss the differences between other standards. So for the purpose of these differences, I have covered two important standards which we have not covered previously, and just these are for the purpose of differences only. So first standard we will cover is, just a moment. The first standard we will cover is the Ind AS 37. I have given references in other standard, but the important concept of Ind AS 37 is the discounting concept. So each and every provision which is generally a long term in nature, you will have to discount, and this discounting has to be done using the risk-free rate of return. So this discounting, so we have discussed decommissioning provision, restructuring provision, any other provision, each provision has to be discounted. And then in case of restructuring provisions, the standard says that you don't have to wait until there is a legal obligation. Even if there is a constructive obligation also, then also you have to provide for the restructuring provision. So don't wait until there is a legal announcement into the company. As soon as there is a constructive obligation, you have to provide for the restructuring provisions. The third difference is contingent assets. So in case of contingent assets, the standard says that if it is virtually certain that the asset will be recoverable, then you recognize the contingent assets. Okay. If it is probable that the contingent assets will be recoverable, in such cases you give a disclosure in your notes to the financial statements. This is a difference between Indian GAAP. In Indian GAAP, you do not disclose the contingent assets. You just give it in some director's report or something. This is about the provision standard. Then you have Ind AS 21. In case of Ind AS 21, what is the difference between Indian GAAP? You have a concept of functional currency in Ind AS 21. Okay, what is the concept of functional currency? For each entity, it might be holding company, subsidiary company, or any entity, you decide which is a functional currency. So what does functional currency mean is, it is currency of prominent or which is of the most importance to the entity, which is of the most prominence to the entity. The standard has given various conditions based on which you have to decide the functional currency. This is one concept which is new under the standard. Then there is a convenience translation concept given under the standard. What does it mean? For example, I have my entity called as Wipro. Okay, I give my financials in US also for the purpose of my disclosure. Now, whenever I need to convert my currency, whenever I need to convert my financial statements from INR to USD, I can use one common rate and directly convert all assets, liabilities, and profit and loss and disclose it in the US countries. Why? Because I'm just giving it for the US entities users to just understand what the financial statements are. And it is for none of the purpose. It is just a convenience translation. And the third is recognition of exchange differences. In accordance with Ind AS 21, none of the exchange differences are allowed to be capitalized in the cost of the asset. This is in difference with the AS 11, where there was a para called as para 46A, which allowed the differences in foreign currency to be capitalized in your property, plant and equipment, in your fixed assets. This is the difference between Ind AS 21 and your AS 11. I'm just covering this quickly because we have not covered this standard, but you should have an idea that what things are different compared to the old standard. And then there is the last standard where there is a completely different standard on agriculture. So in any of your company, if you have any biological assets, the biological assets means animals, plants, or if you have seeds. So if you have in your company where you have such biological assets, you have a completely new standard where the measurement requirements are given. So to give you a quick overview, in accordance with biological asset standard, the asset has to be fair valued at each reporting date. So you have to give the fair value of that asset. If you have trees, if you have animals, if you have, say, if it is a dairy industry who owns the cows and the buffaloes also, this cows are the biological assets for that company, and accordingly you have to what fair value these biological assets at each reporting date. So I hope this is very much clear to you all and you have understood everything in detail. So if you have any kind of queries, you can anytime contact me. I'm just mentioning my contact number. So my mobile number is, you can WhatsApp me the queries if required, or you can email me. Any email is anytime preferable for you all. So this is all about the Ind AS. I hope you have enjoyed all the days, and it was very much good with whoever have attended all the 6 days. I hope you have gained the comfort over all the Ind ASs, and at least you can have a very much fair idea about what all the Ind ASs are. And with regard to the questions, I will reply to all of your questions by way of an email. I will download the questions of each and one of you, and I'll reply to you all by way of an email. Okay. And further regarding, I hope this will help you all to give any kind of review engagements or review any Ind AS clients, or if you want to implement Ind AS anywhere, if the Ind AS is applicable to your company, you can make the transition from the Indian GAAP to Ind AS. Please note, this is the biggest opportunity right now. There are very few CAs who are into this practice, and accordingly, this will help. This knowledge will help. Even if you don't have any such company, it will help you to understand the financial statements which are under this market. And you shouldn't be outdated with the new concept of Ind AS, and it will be helpful for you all.